Hi everybody, welcome to the last two lectures. These last two lectures are going to cover two very interesting areas. First is capital market research, and the other is behavioral accounting research. What these two areas would deal with is related to some of the things that you have covered earlier. If you recall, when you started out, we said that the conceptual framework prescribes that financial information should be useful for decision making, and so as to provide users with relevant information to help them make decisions. And also, we covered under the regulatory theories that accounting standards are prescribed to protect the public or to protect certain private interests. But accounting standards are there to provide information or to guide you to provide information that is relevant for decision making. So there's a lot of push for preparers to provide a lot of financial information that we think are useful for decision making. But the question that you would probably want to ask is that how do we know that these information are useful at the end of the day for these users? How do we find that out? How do we provide evidence of this? So the two group of theories that we're going to cover this week, which is capital market research and behavioral accounting research, attempts to provide some sort of empirical evidence to show that financial information is useful. So that's the whole idea, in terms of why you want to study these two topics. So we'll start off with capital market research. And the learning objective of capital market research, as shown in this slide, is first of all, we would want to cover what is the role of capital market research, as I mentioned just now, to look at the relevance of information that is provided in accounting reports. But we also need to understand how this theory works. And one of the main assumptions of the theory is the assumptions of market efficiency. And we'll cover that and to see how what is market efficiency and why is it relevant to these theories. There are different types of capital market research. Some of them are looking at the information content of accounting disclosures. That's to say, does information really matter? And the second one looks at how accounting information is disclosed. Does that matter as well? And the other learning objective is why is it, specifically when you look at capital market research, we are going to look at unexpected accounting earnings versus abnormal share price. What does that mean? Why is that the thing that we are looking? What's the correlation? What's the link between these two variables? That's going to be the first part of this topic on capital market research. After we have a good understanding of capital market research, we'll go through briefly, not in a lot of detail, but briefly, some of the major findings of capital market research and what does it show, what does it tell us about the usefulness of accounting information. So first off, let's look at a general overview of capital market research. So as I mentioned, capital market research explores the role of accounting and other financial information in equity markets. Now, the assumption is that financial information, the biggest role, the most important role, is to provide information for shareholders of listed companies, and this usefulness of accounting information is going to be best reflected in the share price of these listed companies. So capital market research will involve looking at correlations. If you've studied, remember your statistics is to look at correlation between two variables. And these two variables are financial information as shown in the annual reports of financial statements and the share prices. And essentially what capital market research is trying to do is to measure or look for reactions by investors. The assumption here is that if investors find financial information to be useful, they would react either through buying or selling the shares, and this two reaction by the investors would cause share prices to change. So the assumption or the implication here is that if there is no change in share price, the assumption is that there is no reaction. All right. However, if you think about it, what this is trying to say is that when users look at accounting information, they would either make a decision to buy. If they make a decision to buy, if a lot of people make a decision to buy, the share price would go up because there's a lot more demand. And then the reverse, if the accounting information is such a way that the users find that they want to sell the shares, then it is likely that share price would drop. Okay, so the reaction by the users of buying and selling would result in the changes in share price. But the assumption here is that if there is no change in share price, that implies no reaction. This could imply that the investors have made a decision not to do anything. But not to do anything is also a decision. But if a shareholder or an investor decides not to do anything, and this has no impact on the share price, the assumption is that the information is irrelevant. So there is some limitations in the capital market research that you should be aware of. We will talk about the difference between capital market research and behavioral accounting research later. But as a introduction to the difference, you need to understand that capital market research looks at the aggregate response of shareholders, because if you understand share prices that is shown in the share listings, market results, market listing of companies that you see on a daily basis in newspapers, the closing price of a particular share of a particular company is as a result of possibly thousands of transactions that happens in that day. So the closing price that you see is as a result of the average of all the transactions for that particular period. So capital market research therefore looks at aggregate effect. Okay, so some people might be buying, some people might be selling, but on the whole, what is the effect? Okay, so it averages out the total effect. The other thing about capital market research is that it only looks at share price, and share prices only refers to reaction by investors. It ignores reactions of other users, could be bankers, could be your suppliers, could be your customers. So the capital market research is rather restricted, rather limited in terms of how it views the users. So you have to be careful when you look at capital market research that it only focuses on certain type of users. In fact, it only focuses on one type of users, which is investors, and it looks at aggregate data. But behavioral accounting research, as we will discuss in the coming videos, is that it looks at how individual users behave in response to financial information. You actually go and interview individual people and ask them what sort of information is useful. Is this information useful? And it also covers a wider group of decision makers. So it can cover people like bank managers, loan officers, and even auditors. So it's more at a more individual level, behavioral accounting research, whereas capital market research is at an aggregate level. Now, it doesn't mean that one is better than the other. It's just that it only shows that there's different results, and you have to be very careful when you look at capital market research, and you have to be very careful when you look at behavioral research. We'll talk more about behavioral research later. So these are the main differences between capital market research and behavioral research. Let's discuss what's the reason um, for capital market research. In a sense, what is the rationale for us to be able to link information about earnings to share price? Now, the main argument here is that information about earnings, which is about profits reported by companies, is the primary purpose of financial reporting. In other words, financial reporting is here to provide information about the profitability of a company. And if you are a shareholder holding shares in the company, your main aim is to assess the ability of the company to generate earnings or to generate profit. So information about profits is the main interest of shareholders. This is supported by evidence that says that earnings is the figure or the number or the information that is most focused on or analyzed by your brokers, your analysts that is advising the shareholders as to whether you should invest or not invest in a particular company. And these data concerning earnings are very easily available in the public domain, either in databases or in financial information publications. So this argument tells us that we are able to link information about earnings to share prices. Now let's look at one of the major assumptions of capital market research. And the key assumption for to explain capital market research is the efficient market hypothesis, right? And this efficient market hypothesis is very much relied upon in capital market research. Now, what is this efficient market hypothesis? The definition of efficient markets is that in any market price that is shown in newspapers or in stock exchanges, that price will adjust to any new information that comes out into the public domain, and it will adjust very quickly, right? The more quickly it adjusts to these new information, then the more efficient the market is. So the price that is reflected at all times in the market would have taken into account all publicly available information or all available information. Now, if you recall, you have studied efficient market hypothesis before, there are different forms of market efficiency. There is the weak form, there is the semi-strong form, and there is the strong form. Now, what is the difference between these three different forms of market efficiency? Now, when you talk about weak form of market efficiency, you are referring to the notion that prices merely reflects information about the past prices, or in other words, prices today is only impacted by the price yesterday. It's not any information that is released today is of no relevance. So in a weak form market efficiency hypothesis, the only thing that impacts today's share price is yesterday's share price or yesterday's trading volume. Okay, so that's weak form. Now, when you look at semi-strong form, what the semi-strong form assumes is that today's prices would have included all publicly available information all recent publicly available information, and they include this into the share price quickly and in an unbiased manner. Okay, and that's essentially what semi-strong form is. Now, the difference between semi-strong form and the strong form is that a strong form talks about or assumes that share prices reflect all information, whether it's publicly available or even private information. In other, what is private information? Private information is that those information that is not yet been released into the public domain, released into as public information into the market. So these are the three forms. Now, if you understand strong form market efficiency, you realize that a strong form market efficiency is not allowed. It is illegal in most markets. Why is it illegal? Because when you talk about private information, you're actually talking about insider trading. That means to say that some investors are able to trade in the shares with knowledge of information that other people are not aware of. Now, this insider trading concept is, of course, not allowed, or it's illegal in most markets. So we cannot rely on the strong form market hypothesis. The weak form market efficiency hypothesis does not even consider any publicly available information. It only looks at prior prices. So you also cannot rely on the weak form. Therefore, is the semi-strong form the assumption that a company's share price will change or will be impacted by all publicly available information rapidly and in an unbiased manner? Would therefore tell us that we can then say that these publicly available information are information that is contained in annual reports that are released into the public domain. Okay, therefore, if we want to study the connection between earnings and market prices in capital market research, you therefore need to assume that the market is efficient under a semi-strong form situation. So in other words, the semi-strong form will be the most applicable market efficiency hypothesis to be applied in capital market research. So what's the implication of market efficiency on capital market research, or the understanding of the impact of accounting information on share price? So basically what capital market research says, that if markets are efficient, they will be able to use information from various sources when predicting future earnings, and as a result will have an impact on share prices. So these information from various sources includes accounting information, and therefore accounting information would have an impact on share prices if the semi-strong form market efficiency hypothesis prevails. Alternatively, what it means is that if accounting information therefore does not impact share prices, then it is deemed that there's no information value in accounting, because the assumption is there is market efficiency, at least at the semi-strong form. So that's in essence the impact of why holding a particular hypothesis of market efficiency is important. Next, let's look at how, therefore, if we assume that the market is therefore semi-strong form in terms of its efficiency, how can we explain the connection between earnings and share price? And what sort of earnings are we talking about, and what sort of impact on the share price that we are talking about? So the assumption and the basis that we base our capital market research on is that share prices, how share prices are derived is that share prices are the sum of the expected future cash flows that's predicted from this particular company. So it's the same argument that I've told you all before, that when you look at a price that you pay is actually what you can get from this particular item or assets or shares for the foreseeable future, in the future. And mathematically, it's actually discounting all that future cash flow to the present. And this present value of future cash flow is deemed to be price, the price that you are willing to pay. So if you apply this in the same way to share prices, so share prices is actually can be deemed as the present value of the future cash flows that you can generate from this share. And what is the future cash flow that you can generate from these shares? Well, in the case of a company, in the case of you holding shares in a company, that cash flow will be coming from dividends. And if you understand that, then the next thing that you do is to then connect dividends to profits. How do you connect dividends to profits? Well, dividends are distributed from accounting profits. And therefore you have this link between accounting earnings to dividends, which is going to be distributed as cash, and if you discount all these, it will arrive at your share price. So therefore we have this link. We have this link between accounting earnings and share price, all based in the context of an efficient market, at least at the semi-strong form level. So that's where the connection of earnings and share price would be placed. Then let's take it one step further. What sort of earnings are we talking about? And what sort of share price? Are we actually looking at absolute earnings compared to absolute share price? The answer is no. What we are looking at is an unexpected change in the earnings as opposed to absolute earnings. Right? So we don't look at absolute earnings, we look at the change in earnings. So if there has been an increase in earnings during that period, and this is unexpected increases in earnings, and I'll explain why that is so later, what is the change in share price? Okay, this is the connection that we explore in capital market research. Now let's look at why we use unexpected change in earnings, looking at changes in share price, and why don't we look at the absolute earnings? This is based on the idea that the impact of share prices in a market has got two variations, two variances. If you remember your capital asset pricing model, if you remember portfolio theory. In portfolio theory, if you remember, there is systematic and non-systematic risks. Systematic risk is the risk of the market as a whole, whereas non-systematic risk is firm-specific, it's the business-specific. Basically, in capital market research, we don't look at systematic risks because systematic risk is not firm-specific. So it doesn't really rely on the particular firm's earnings. Okay, it's what happens in the market. So what we do look for non-systematic risk, is risk specific to that particular company. So we focus on that, and as a result, because we focus on that, we will assume that market risks, the systematic risk, refers to normal returns, whereas the non-systematic risk, the company-specific risk, the firm-specific risk, is related to abnormal returns. And it is the abnormal returns that we are interested to look at, because it is the abnormal returns that would be firm-specific based on the accounting profits that the firm earns, and how it impacts the share price. So therefore, when in capital market research, we actually look at abnormal returns as an indicator of information content specific to that firm. So that, in a nutshell, is the principles, the theory behind why we use capital market research, and what are the components, and why we think that there is a connection between accounting earnings and share prices, and therefore why we think we can rely on capital market research to tell us whether accounting information, accounting earnings per se, is useful or not by looking at reaction to share price. The next thing they want to discuss is what are the main results of capital market research over the years. But we'll take a break, and I'll come back and talk about that in another part of the video. So I'll see you later.